Welcome back to the deep dive. Today, we are strapping in for, well, a pretty high-stakes legislative battle. It's something that affects everyone from, the global tech sector right down to the small business owner just trying to buy supplies overseas. We are diving into the Virtual Assets and Virtual Asset Service Providers Bill 2025. It's a proposed law that has generated a huge amount of friction, really quite intense friction between regulators and the burgeoning digital economy here.
Yeah, this deep dive lands us squarely in the middle of a major conflict. I mean, the core tension is this. The bill, which the Minister of Finance introduced back on September 12, 2025, is primarily intended to align the country with critical international anti-money laundering standards.
Right, the FATF ones.
Exactly, specifically those set by the Financial Action Task Force, or FATF. But the immediate response from stakeholders in the digital currency space is, well, it's intense, it's unified, and frankly, deeply concerned.
And that's the core tension we really need to unpack for you, the learner. Our mission today is to go beyond, let's say, the political rhetoric.
Yeah.
We need to analyze exactly what this short 10-clause bill proposes, and it essentially proposes a sweeping, multi-year ban.
A ban, yeah.
We need to understand the government's very serious concerns about crime, fraud, and global compliance. And crucially, examine the powerful concerns raised by the business and tech community. Why are they warning that this ban could cripple the future of the digital economy?
Right.
Specifically, harming your ability as a listener to access foreign exchange, transfer money quickly, or even just manage your personal investment portfolio.
And we do need to acknowledge the immediate context here. Regulators are definitely reacting to some very public, high-profile fraud cases.
Yeah, those were big news.
And there's a genuine need to comply with international obligations. The solution they've proposed, though, is this temporary blanket prohibition that lasts until late 2027. So we have to scrutinize the architecture of that ban and really assess whether the industry's claim holds weight. Is the response disproportionate? Does it threaten legitimate economic activity? That's the core question.
Okay, let's get into it. Part one. The architecture of the Virtual Assets Bill 2025, the official stance. So let's unpack this bill. At its heart, the legislation is titled An Act to Regulate the Conduct of Business Concerning Virtual Assets and Virtual Asset Service Providers. Now, that might sound like a step toward regulation.
It sounds positive.
But it's actually an act of immediate moratorium, a complete stop. Why the sudden drastic move?
Well, the urgency, it really stems entirely from international pressure and the timeline for compliance. The country is undergoing the Caribbean FATF fifth round of mutual evaluation right now.
Which is a big deal.
It's a crucial assessment. It determines whether the country is adhering to global standards for combating money laundering and terrorist financing, AML-CTF. Failing this evaluation has really serious repercussions for the entire financial system.
Okay, so the government needed a quick fix, something to show they were tackling the problem before the examiners basically came knocking.
Essentially, yes. You see, the FATF issued Recommendation 15 on new technologies. That mandates that jurisdictions regulate and supervise virtual asset service providers, or VASPs. They also issued Recommendation 16, which includes the highly controversial travel rule.
Controversial is right.
Yeah, requiring VASPs to transmit originator and beneficiary information for all transactions over a certain threshold. So given the rapid, kind of unregulated growth of the local crypto scene, the central bank supported this bill as a measured first phase. That's their term, because there wasn't a comprehensive regulatory framework in place.
Right.
Their logic seems to be stop all activity first, assess what they see as a massive risk, and then build the framework.
But calling a blanket ban until the end of 2027 measured? I mean, that seems like a huge stretch, doesn't it? That's over 2 years of enforced dormancy for a fast-moving global industry.
It absolutely does seem like a stretch. However, the regulators, they defend the timeline. They argue that this time is needed for the Securities Exchange Commission, the SEC, and the Financial Intelligence Unit, the FIUTT, to complete a thorough, data-driven risk assessment.
Which isn't even done yet.
No, it's expected in the next couple of months, apparently. And that assessment will then inform a proportionate risk-based framework. The central bank also pointed to Belize, saying they took a similar temporary freeze approach while their regulators got up to speed.
Okay, let's nail down the core prohibition then. What exactly is being banned, and what's the timeline again?
Okay, so the bill proposes a temporary prohibition on commercial virtual asset activities until December 31st, 2027.
Right to the end of 2027.
Exactly. And that date isn't arbitrary. It's the date the regulators anticipate being ready to move from this prohibition phase to licensed regulation. The bill explicitly prevents the SEC from granting any authorization for these activities until that date.
Okay. And who gets classified as a virtual asset service provider, a VASP? The term sounds technical, but I suspect it covers a huge range of activities.
Oh, it does. The scope is intentionally exhaustive. The ban applies to anyone defined as a VASP and, crucially, also to digital wallet service providers.
Sure.
The bill defines 5 major prohibited activities if, and this is key, if they are conducted as a business or in the course of a business.
As a business, okay.
It's essential to remember that qualifier as a business, but we'll see later why the industry thinks that qualifier is still dangerously broad.
Right. So what are those 5 prohibited activities? Let's list them out.
Okay, first, the exchange between virtual assets, VAs,
Yeah.
fiat currency, TTD. This is your core on-ramp and off-ramp. Converting Bitcoin or stable coins back into local dollars if you shut this down.
The whole local system becomes unusable.
Pretty much, yeah.
Yeah.
Second, the exchange between one or more forms of VAs. So crypto-to-crypto trading services offered commercially.
Got it.
Third, the transfer of virtual assets. This targets services that facilitate transfers between wallets, but on behalf of others.
Okay.
Fourth, the safekeeping or administration of VAs on behalf of another person. This includes all commercial custodial services. Think of companies that manage or store your crypto keys for you.
Right, the custodians.
And fifth, the provision of financial services related to the offer or sale of a VA. This covers the infrastructure behind things like initial coin offerings, ICOs.
Wow, okay. That covers almost every commercial aspect of the digital economy. So
Yeah.
what happens to the legitimate exchanges and wallet providers already operating? They can't just disappear overnight, surely.
Well, they face severe, non-negotiable operational requirements. Clause 4.5 dictates that existing operators must notify the SEC within 1 month of the bill becoming law.
1 month's just to say we exist.
Exactly. That's just to admit they exist. Then, they must cease all virtual asset activity within 3 months of the bill commencing.
3 months? That's incredibly short.
It's considered devastatingly short by the industry. It forces immediate, complete operational shutdown with basically no transition period.
Okay, why the hammer approach? We know FATF compliance is a driver, but the Minister of Finance didn't exactly shy away from connecting this specifically to high-level corruption and crime, did he?
No, he made very forceful public statements. He argued the unregulated industry is, and I quote, easily being misused to facilitate money laundering by those involved in illegal drugs and multiple other forms of criminal activities.
Okay, that's strong claim.
And he also explicitly cited intentions to, again quoting, penalize those responsible for siphoning billions of taxpayers' dollars into the pockets of a special few.
Hold on a second there. While money laundering through crypto is definitely a global concern, was specific evidence provided linking cryptocurrency use to that particular issue, the siphoning of billions in taxpayer dollars? Or was this maybe a case of associating the new, poorly understood technology with existing, highly emotional corruption issues?
Well, sources indicate that specific, detailed evidence linking crypto to those high-profile corruption cases wasn't actually provided alongside the bill. However, the central bank did emphasize consumer protection. They noted their awareness of several investment scams recently perpetrated on citizens.
Like that Trillions case.
Exactly, like the highly publicized case involving Trillion Systems Ltd., where, nearly 3,000 investors were reportedly waiting for returns. The SEC also issued multiple warnings about unregistered promoters and pyramid schemes using virtual asset language.
Right.
So while the rhetoric might be targeting high-level corruption, the immediate undeniable problem the regulators are facing is widespread consumer fraud and investment scams happening in a completely unregulated space.
Okay, that makes sense as a driver. Let's pivot now to part 2. The problems and disproportionate impact. Let's look at the business community's critique. If the goal is to stop billions from being siphoned off, why are they penalizing the small, legitimate actors so heavily? The penalties laid out in this bill are, frankly, terrifying.
They really are unprecedented in scale, especially when you compare them to similar white-collar or financial interactions. Stakeholders are deeply concerned that the penalties are grossly disproportionate. They argue it hits legitimate businesses far harder than the typical fine structure you see for violations in traditional banking or securities.
Okay, give us the specifics on the penalties. Just how severe are we talking?
Well, the initial penalty for just failing to notify the SEC within that 1-month window is a $125,000 fine.
Right.
But the critical point, the really scary part, is the criminalization of continued operations after the 3-month cessation period.
Right.
If a VASP or its directors continue unauthorized activities, the penalty is a staggering $5 million fine and imprisonment for 5 years for individuals, directors, and officers.
$5 million and 5 years in jail. For providing a service that's perfectly legal in places like Cayman or the U.S., that's an extraordinary level of risk for business owners.
And it gets worse. For a continuing offense, meaning if the business operates for more than 1 day after the ban takes effect, there's an additional fine of $500,000 for every single day the offense continues.
$500,000 a day.
Per day. Even unauthorized advertising carries a $125,000 fine and a year in jail. So stakeholders argue that criminalizing legitimate, revenue-generating business activity with such extreme sanctions is, well, they say it's like using a tactical nuclear weapon to solve a regulatory problem. The punishment just drastically exceeds the risk posed by compliant actors trying to innovate.
Okay, beyond the legal risk, let's talk real-world economics. Probably the most persuasive argument I've heard from the industry relates to the chronic foreign exchange shortage, the Forex crunch. How have cryptocurrencies become, as they say, a lifeline for businesses trying to deal with this?
Yeah, for small and medium-sized enterprises, SMEs, crypto has really evolved into a legitimate, almost necessary mechanism to circumvent institutional constraints. Local banks impose severe daily limits on credit cards and bank access for foreign purchases.
I've heard stories about that.
Yeah, we've heard anecdotes of limits being as low as $200 per day for foreign transactions. Now, if you're an importer of goods or if you need to pay for essential foreign services like software or specialized equipment, a $200 limit is absolutely unworkable.
Completely. So how does crypto act as the workaround there?
It acts as an efficient legal rail, essentially. A business owner can buy cryptocurrency, usually a stablecoin, pegged to the US dollar using TTD from a local VAP. They instantly convert that TTD into a digital US dollar equivalent.
Okay.
They then use that digital asset to pay their international suppliers or purchase essential imports, things like vehicle parts or specialized software services, which often cost thousands, not just hundreds, of dollars.
Mm-hmm.
The local VASP facilitates that crucial on-ramp from TTD to the crypto Forex equivalent.
But wait, I have to challenge that perspective a little. If the banks are imposing those low limits, aren't they often doing so to manage the national foreign exchange reserves or maybe prevent capital flight? Isn't this crypto workaround simply circumventing necessary financial control mechanisms, even if it helps the individual business owner?
And that's the critical counterargument the regulators implicitly embrace, you're right. However, the industry argues back that the bank's limitations often stifle legitimate, documented international commerce, not just speculative capital flight.
Mm-hmm.
The business owners making these claims say they're using crypto to pay for goods and services they need to import to keep their local operations running, to employ people locally. By shutting down the local, traceable VASPs, many of whom implement Know Your Customer and anti-money laundering checks already.
Right, the compliant ones.
Exactly. By shutting them down, the government isn't stopping the demand for foreign currency. They're just removing the most efficient, legal, and potentially trackable method for satisfying that demand. Stakeholders warn that this ban will instantly throw the country, quote, right back in the situation we were in before, where no one can access Forex, potentially stifling critical commerce and even necessities like paying for overseas university fees.
Okay, shifting gears slightly, let's look at the human cost. Remittances. This isn't just about business transactions, it's about family support, money flowing in and out of the country from the diaspora. How does the ban affect that?
This is another area where crypto has become a vital financial lifeline for many. For individuals who earn US dollars abroad and for families locally who depend on those funds, virtual assets again, primarily stablecoins pegged 1.1 to the USD, like USDT or USDC, are often seen as infinitely superior to traditional money transfer services.
Okay, how does the comparison stack up against established services like, say, Western Union or MoneyGram?
Well, the differences are pretty massive, primarily in speed and cost. Traditional services involve significant transfer fees, sometimes quite high percentages, and often require a lengthy settlement period. Even if the money is digitally sent, the local recipient might face a 2 to 3 day wait before they can actually access the cash. especially if the transaction happens over a weekend or a holiday.
Right, the banking delays.
Exactly. With stablecoins, funds are moved instantly. I mean, literally, a wallet-to-wallet transfer takes maybe a second, regardless of whether it's Saturday night or a public holiday, and potentially for just a few cents in transaction fees, depending on the network.
So a person in the diaspora could send money Saturday night, and the recipient, if they could use a local VASP, could convert that money into TTD almost instantly.
Ah.
The ban completely shuts down that crucial final step, the off-ramp.
That's precisely it. Industry estimates suggest that somewhere between US $40 million and US $50 million a year could potentially flow into the country just via remittances if local banks were enabled to properly offboard crypto from compliant VASPs.
Wow, that's significant.
Yeah. Shutting down the local infrastructure, the on-ramps and off-ramps, is effectively eliminating that faster, cheaper, more efficient transfer rail. It forces people back onto slower, more expensive, and often less accessible legacy systems.
Okay, now let's talk directly to the casual investor. You know, the listener who might hold some Bitcoin, maybe some Solana or Cardano as part of a diversified personal portfolio. They aren't running an exchange, they're just holding assets. How does that carrying on of business clause affect them? Is personal holding okay?
This is the gray area that causes massive regulatory anxiety for individuals. While the bill doesn't explicitly ban personal ownership, you can still hold crypto in your own decentralized wallet. That's generally understood. It effectively criminalizes your ability to liquidate those holdings into TTD locally.
How so?
Well, the minute you try to convert your assets, say your Bitcoin profit, back into local fiat currency, you need to interact with a VASP, an exchange, or a broker. And those local VASPs are banned from operating.
Ah, right. So if you made a profit on Bitcoin, you might be forced to engage in riskier, unmonitored peer-to-peer transactions, maybe meeting someone in person or trying to use an offshore account, basically circumventing the very system the government says it wants to monitor.
Precisely. It pushes activity underground. Furthermore, the ban also impacts people using specialized crypto cards for everyday purchases. These cards often link directly to virtual asset holdings and provide a foreign currency equivalent spending capability.
Right, I've seen those advertised.
And again, they frequently give the holder higher daily transaction limits than those imposed by local banks. So by crippling the local infrastructure that facilitates the loading and conversion of funds onto these cards, the government is inadvertently making life more difficult for consumers seeking better financial access or trying to manage within those low bank limits.
And what about the impact on creative sectors? You hear a lot about NFTs and digital art. Does this bill inadvertently criminalize an artist selling an NFT, for example?
It absolutely could. The bill's broad definition of VASP activities, particularly that carrying on of business phrase, could easily sweep in profits made by artists and art collectors who have tokenized their art on the blockchain as non-fungible tokens, or NFTs.
So if an artist sells an NFT for, say, Ethereum, and then uses a local service if one existed to convert the ETH back into TTD, that could be seen as a banned activity.
Under a strict reading, yes. Or if a local developer creates and sells a non-custodial wallet application and accepts crypto payment for it, that activity could be interpreted as carrying on a business concerning virtual assets. This ambiguity really deters investment and engagement in the artistic and cultural sector. It potentially halts a major avenue for the digital economy to monetize local talent globally. That vagueness of the carrying on of business clause is the critical choke point for the average person, not just big exchanges.
Okay, moving to part 3. The innovation deficit and regulatory blind spots. When you look at the totality of the impact stifled Forex access, crippled remittances, potentially criminalized investors and artists, it's easy to see why digital currency players liken the ban to throwing the baby out with the bathwater.
Yeah, that phrase perfectly captures the sentiment across the industry. They see this as a profound backward step. The irony, they argue, is that the government is shutting down the very infrastructure that could bring the country into the digital future. They are risking gutting what they call a burgeoning high-tech sector.
And in a global context, this makes the country look completely out of step with competitors, doesn't it?
It sends a terrible international signal, absolutely. Countries like Japan, South Korea, and maybe most notably the entire European Union with its comprehensive MiCA regulation. They aren't running away from digital assets. They're implementing detailed, progressive frameworks to regulate them to bring them into the mainstream safely.
Right, they're building bridges, not walls.
Exactly. So when TNT opts for a blanket ban until late 2027, it basically screams to international venture capitalists and tech companies that the country is not innovation forward. And the fear is that business and talent will just flee to, as one attorney put it, die other serious islands in dem. That means losing valuable investment, jobs, and innovation to regional competitors who are embracing this.
Let's discuss the inevitable consequence of banning a decentralized technology. You can't really ban Bitcoin itself, can you? So what happens to the activity? Where does it go?
This is the major regulatory blind spot, and it arguably runs counter to the bill's stated AML-CTF goals. A ban doesn't eliminate crypto ownership or trading. It only eliminates the regulated, potentially traceable method of accessing it locally. Instead, the activity gets pushed into riskier, unmonitored channels.
Which channels specifically? What are we talking about?
Primarily, we're talking about offshore exchanges and platforms which are completely outside the jurisdiction of the local SEC and FIUTT, and also unmonitored peer-to-peer P2P trading.
So direct deals between individuals.
Yes, often arranged online or through social media, with no intermediary oversight. Remember, local VASPs, even before this bill, were often implementing their own Know Your Customer, KYC, and anti-money laundering AML controls simply because they needed to satisfy their own institutional banking requirements to operate.
Right, they had skin in the game.
By shutting them down, the government forces that trading activity onto decentralized platforms or direct wallet-to-wallet transfers, which completely bypass any local AML-CTF oversight.
So the net effect could actually be that they are making questionable activity harder to trace for the Financial Intelligence Unit, kind of the opposite of the bill's intention.
Precisely. That's the argument. They eliminate the compliant, potentially transparent infrastructure and unintentionally create a thriving black or gray market for crypto liquidity. This loss of legitimate local infrastructure also drives away business, potential tax revenue, and keeps capital from circulating effectively.
And there's another consequence too, right? The brain drain.
Yes, compounding this is the very real threat of brain drain. The fintech space, even if small, employs highly skilled local talent, software engineers, marketers, compliance experts, technical support. If the only avenue for commercializing their specific skills is banned locally,
They'll look elsewhere.
they will be forced to seek employment outside of TNT, maybe remotely for foreign companies, or they might just emigrate.
Yeah.
This further erodes the nation's technical capacity and its future competitiveness in the digital sphere.
That leads directly to the industry's concern about the policymakers themselves. Is there a perception, fair or not, that the bill was perhaps drafted without adequate technical understanding of the very assets they are attempting to regulate?
Yes, there is a strong sentiment of a disconnect there. A local business owner used a telling analogy. The government is throwing a net to catch a fish, but they will be catching fish, snail, shrimp, a few things in one.
Meaning it's too broad, catches everything.
Exactly. It suggests a legislative drafting process that perhaps used overly broad language because it lacked the specific technical expertise to define and target only the genuinely illicit behavior, the bad actors.
So instead of carefully targeting the large-scale criminal activities the minister cited, the bill is inadvertently catching the small artist selling an NFT, the everyday investor managing their portfolio, and the legitimate SME just trying to pay for imports using a faster rail.
That's the core criticism. And this underscores the industry's fervent belief that public education and, critically, policymaker education on the technology itself are absolutely vital. You really cannot effectively regulate a complex system you don't fully understand.
Right.
If you don't grasp the nuances, the difference between a custodial wallet and a decentralized platform, or the difference between a high-risk, unregistered token and a fully backed stablecoin, you might end up proposing a blunt instrument like a multi-year blanket ban because it seems like the simplest, safest option in the short term.
Okay, let's move to part 4, alternative solutions and progressive frameworks. Because the consensus among industry players isn't really to abandon regulation entirely, it's to embrace smart regulation. The key message seems to be, regulate, don't restrict. Let's explore the suite of progressive alternatives proposed by stakeholders like WAM Money, PESH Money, and FinTech TT.
Absolutely. The industry almost universally acknowledges the necessity of regulation. They want it for consumer protection, for legitimacy, for building trust. But they universally agree the blanket ban is, quote, completely unnecessary. They argue there are numerous pathways to achieve the necessary FATF compliance without crippling the entire sector.
Okay, so what are the specific actionable alternatives they're putting on the table?
Well, the most immediate and widely advocated alternative is the regulatory sandbox. This is an approach that was actually previously contemplated by the central bank's own Joint Regulatory Innovation Hub, so it's not a totally alien concept.
Right, I remember hearing about that initiative. How would a sandbox work in this context?
A sandbox basically allows pre-approved entrepreneurs, fintech companies, to build and test their virtual asset solutions like exchanges or wallet services, but in a strictly controlled environment.
How does that help with the risk assessment the regulators say they need to do?
It allows innovation to continue safely, which is crucial. But it happens under very strict conditions, maybe limited user numbers, transaction caps, and intensive monitoring by the SEC and the FIUTT. Policymakers can then collect real-world operational data, observe how the technology actually works in the local context, and use that data to finalize a comprehensive framework based on observed risk rather than just theoretical fear.
So it keeps innovation flowing, but safely.
Exactly, without opening the floodgates to potential fraud while everyone gets their ducks in a row.
What about systems for larger, more established businesses? A sandbox sounds more like for startups.
Right. For that, they proposed a tiered licensing system. Instead of a one-size-fits-all set of potentially very expensive compliance demands, the suggestion is to implement different regulatory requirements, different capital requirements,
Right.
based on the scale and the specific risk profile of the VASP.
So a small local startup wouldn't face the same huge regulatory burden as, say, a massive international exchange setting up shop.
Precisely. This encourages the smaller, potentially more innovative, compliant local actors to actually stay in the market and grow, rather than being regulated out of existence from day one.
I find the suggestion regarding financial thresholds particularly interesting because it seems to address that problem of catching the casual investor versus the big criminal enterprise directly.
Yeah, it's a very pragmatic potential solution. The idea is to limit the applicability of the really severe penalties and the most stringent regulatory restrictions to activities that happen above a certain minimum annual value. Someone threw out a figure like, say, $50,000 per annum.
Yeah.
This approach would immediately exempt most casual investors just managing their own funds.
Yeah.
Probably artists selling a few NFTs, and small businesses using crypto for relatively minor Forex workarounds. Regulators could then focus their limited resources, their enforcement efforts, on targeting the large-scale money laundering operations, the billions the minister was concerned about, without criminalizing the average citizen just trying to navigate the system.
That really does seem like a sensible middle ground. It respects both the need for serious compliance and the realities of the local economy. But what specific arguments do the regulators make against something like a tiered system or thresholds? Is it just seen as too complex for them to manage effectively?
Well, the implicit regulatory counterargument, you could say, is that any threshold immediately creates a potential loophole. Illicit actors could try to exploit it through structuring, breaking down large sums into many smaller transactions to try and fly under the regulatory radar.
Structuring.
However, the industry's response to that is, well, look, this is already a known problem in traditional finance, right? And existing anti-money laundering systems, the software and processes banks use, are specifically designed to detect structuring behavior.
Good point.
So they propose imposing standard transaction reporting requirements on VASPs, basically identical to those already required of banks. Force exchanges to report suspicious activity automatically. That strengthens AML/CTF enforcement significantly while keeping the legitimate rails open. They also suggested local custody rules requiring licensed providers maybe hold a certain percentage of customer assets in local banks, ensuring capital stays circulating locally and adding another layer of oversight.
Okay, let's look at perhaps the most proactive solution proposed, the TTD stablecoin. This sounds like a highly ambitious idea.
It is definitely a bold, maybe even visionary proposal. It was put forward prominently by Wham Money. The core idea is for TNT itself to issue its own national TTD virtual asset, or TTD stablecoin. This would be fully backed, one-to-one, by the local currency held in reserve, and it would be centrally managed, or at least regulated.
So turning the whole thing on its head, instead of just regulating external cryptos, create our own.
Exactly. It flips the entire Forex and digital asset problem from being purely a risk to manage into a potential national opportunity.
How would a TTD stablecoin actually help the local economy, though? What are the mechanics?
Well, proponents argue, firstly, it could attract foreign direct investment by creating a predictable, reliable, regulated local digital asset that international businesses could use. Secondly, it positions TNT potentially as a regional fintech hub, setting an example for the wider Caribbean.
A leader, not a follower.
Right. And perhaps most importantly for everyday people, it could directly address the remittance problem we discussed. Individuals could transfer TTD stablecoins instantly, 247, providing immediate access to funds locally and potentially capturing remittance flows that currently go straight to international money transfer services, bypassing local banks.
Yeah, imagine being able to transfer money instantly on a weekend or holiday without that typical 2 to 3 day banking delay we all know.
It's a way of potentially turning the technology into a tool for national benefit, improving financial inclusion and efficiency instead of viewing it purely as an external threat that needs to be banned.
Finally, what lessons can TNT maybe learn from its regional peers or even further afield? Are there models that work better?
The industry frequently points to the Cayman Islands VASP Act of 2020 as a prime example of more balanced legislation. The Cayman framework explicitly focuses on regulatory oversight without resorting to criminalizing personal use or related development activities.
How does it do that?
Crucially, the Cayman VASP Act explicitly excludes two key things from its definition of a regulated virtual asset service. One is the development or sale of software applications, protecting tech innovation. And the other, most importantly, is personal use of a virtual asset.
Ah, that small, specific clarification explicitly excluding personal use would instantly protect the casual investor managing their own funds, the artist selling their work, and maybe the small business owner using crypto for legitimate remittances or payments. It seems like that would mitigate many of the concerns we discussed earlier.
Exactly. That carve-out for personal use is seen as key. So instead of following models like the US or the EU, which are accelerating comprehensive regulation and integration.
All right, like MICA in Europe.
Yeah. Instead of that, TNT's approach with this bill is seen by critics as fundamentally reactive and overly restrictive. It fails, they argue, to distinguish effectively between the bad actors the minister rightly wants to catch and the legitimate innovators and everyday users who are trying to solve genuine economic problems, like navigating the Forex crunch or sending money home more efficiently.
Okay, let's try and synthesize this as we wrap up. This entire deep dive reveals a fundamental conflict, doesn't it? The virtual assets bill seems like a reactive necessity, certainly driven by the genuine demands of FATF compliance and a very real desire to curb those high-profile investment scams and illicit finance.
The drivers are real.
But its proposed structure, this blanket ban on all commercial VASP activity until December 2027, is being widely criticized as overly prohibitive, as lacking nuance, and as potentially devastating to the very economic actors who, ironically, provide essential workarounds for things like foreign exchange access and remittances.
Yeah, what's really fascinating here is the potential for a massive regulatory miscalculation, arguably. We see regulators trying, understandably, to solve the very real problem of illicit finance and consumer fraud. But they might be doing so by potentially driving the entire ecosystem, including the good actors, the ones who have voluntarily implemented KYC-ML controls already into the shadows.
Right.
By eliminating the legitimate, traceable on- and off-ramps, they could inadvertently increase consumer risk, make money laundering harder to trace, while simultaneously costing the country critical years of digital innovation and driving away valuable technical talent. It's a complex trade-off with potentially severe unintended consequences.
And the industry's alternatives that we discussed, things like sandboxes, tiered licensing, maybe even embracing a national stablecoin, they demonstrate that there are potentially progressive, compliant paths forward that could balance protection with essential economic growth and participation.
Which really raises an important final question for you, the learner, to consider. The bill imposes this freeze, this pause, until December 2027. If the industry and the government were to collaborate now on some of these progressive alternatives, like a regulatory sandbox, for instance, what vital economic opportunities, thinking about job creation, global competitiveness, even solutions for the Forex situation, what might TNT be missing out on by maintaining this effective 5-year pause? A pause that really risks pushing the nation further backward in the global digital race.